We are expecting prices to continue to rise in 2026, and that's largely due to the expansion of the first home guarantee scheme. We've actually got an increase in real incomes as well. And we've also got consumer sentiment rising, which also plays out quite positively well for our housing market when we have got an increase in consumer sentiment.
Want to know what to expect to Australian property in 2026? The Chief of Research at Domain Group, Nicola Powell, was recently on ABC News, and in this video, I'll give you the key warnings addressed in that special. Here's the 8 critical market warnings directly from her latest report. The Australian property market is not just rising, it's shifting gears. Sydney is now on a path to the $2 million mark by 2027. If you're waiting for a crash, the data suggests you're being left behind. Warning 1. The $2 million pathway. Nicola Powell's data confirms fresh record highs are expected across the board. She forecasts Sydney's median house price to hit just over $1.9 million by the end of next year. Powell states this sets the definitive pathway for a $2 million median by 2027. Warning 2. Government fueling the market. Powell identifies what is driving this forecast. She points to the expansion of the first home guarantee scheme as a primary driver. This is compounded by an increase in real incomes and rising consumer sentiment. Powell argues that when sentiment rises, it plays out positively for market activity. Warning 3. The rate cut reality. Powell advises that we are still seeing the flow-on effects of previous rate cuts. Regarding 2026, the forecast factors in the likelihood of one more rate cut midway through the year. She notes that these adjustments continue to flow into the housing market well into the first half of 2026. Warning 4. The return of the giants. Powell predicts a major shift in which cities will see the largest gains. She states growth is moving back to interest rate sensitive cities, specifically Sydney and Melbourne. According to Powell, these markets amplify changes in the cash rate faster than others. She notes that while Adelaide, Brisbane, and Perth will still grow, their double-digit surges are likely over. Warning 5. The inevitable slowdown. Powell warns that the current pace of growth cannot last forever. She forecasts that affordability pressures will begin to weigh on the market by midway point of 2026. Consequently, she expects the pace of price growth to wane in the second half of the year. Powell identifies this as a natural reaction to the rapid double-digit increases seen recently. Warning 6. The shift to units. In a surprising twist for Brisbane, Perth, and Adelaide, Powell forecasts that unit prices will actually outperform house prices. She attributes this to a changed affordability landscape. Powell suggests that units are becoming the necessary entry point as houses become out of reach in these cities. Warning 7. The competition conflict. Powell highlights a concerning trend regarding investor activity. She reveals that approximately 80% of investor loans are currently for purchasing established housing. According to Powell, this is not good news for first home buyers, who must now compete directly with investors. She predicts this competition will be particularly fierce in the first half of next year. Warning 8. The rental strain. Lastly, Powell addresses the rental market. She forecasts that rental prices will continue to rise across all capital cities, though at a modest rate in line with inflation. However, she specifies that unit rents are expected to grow faster than house rents in most capitals. Powell describes the rental market as having been extremely strained over the years, with that pressure set to continue for apartment living. The data from Dr. Powell is crystal clear. The Aussie market is moving fast. These 8 warnings paint a picture of rising prices, high competition, and opportunities that are constantly shifting. Navigating the Aussie property game right now takes more than just knowing general numbers. It requires nailing your numbers. Here's a serious tip, a bit of a secret weapon for pre-approval. When you lock in your approval, the bank guarantees your borrowing capacity for the pre-approval period. That means if the Reserve Bank or your bank changes policy, or if interest rates rise, your capacity stays locked in. It can't move. But here's the best part. If rates decrease during that time, you can increase your borrowing capacity. You get the safety net against the rising cost of living and policy changes, but you can still cash in on a rate cut. Secure a full professional borrowing capacity assessment using the link in the description right now. If you're not ready to commit to that just yet, no worries, that's totally fine. But please do yourself a favor, smash that subscribe button to keep updated with the latest market info.